Hey everybody, this is Tasha Nicole, the entrepreneur, self-employment tax specialist, business consultant, and entrepreneur educator. So I'm recording this in my home office. That's why you see all that stuff on the back of the wall. All right, and this is going to be the back to school edition of income taxes. Whoop-de-doo, so boring, right? But hey, we need to know what we need to know. So I have my notes here. A lot of the questions, I've been getting numerous questions this summer, but one of the biggest questions I've got this summer related to, hey, my child worked this summer, and your child meaning could be a high school student, high school graduate, college student, college graduate, okay? But the main thing has been, my child worked this summer. Am I still able to claim the child or what? And some people have also wanted to know, hey, where are these taxes coming out? I still claim my child. Why are these taxes coming out? So first, these are my notes. I want to try and remember to tell y'all as much as I can, okay? Oh, and let me just stop and say this is for informational purposes only. If you're not a personal tax client of mine, this is not considered tax or legal advice. It's for informational, educational purposes, and you should definitely seek the advice of your own tax professional. But you're more than welcome to reach out to me if I have room for you. Okay, so first, let me talk about the taxes that were withheld if your child worked this summer, okay? Number one, if you do still claim your child, and when I say child, I'm referring to 16, 17 and up. Okay, if your child worked this summer, should you, first of all, you were probably concerned about, hey, what taxes were coming out? And they were traditional taxes, federal, state, Social Security, Medicare. In some cases, they were disability. But let me back up a minute and say, actually, federal and state and local, depending on where you live, if you have local taxes, those taxes actually shouldn't have been coming out if your child had put exempt, payroll, okay? Or if you had helped your child complete that W-4 form, when we all get hired on a job and we got to fill out that W-4. So yeah, you should have put exempt, or payroll should have put exempt, and then the only thing that should have been coming out was the Social Security and Medicare taxes. All right. So first, let me say that if your child went exempt, yeah, those taxes are going to come out. Now, if the exemption status wasn't claimed and federal and state taxes did come out, it's not the worst thing in the world, because here's what can happen. At tax time, your child can actually file an income tax return, but the key thing here is they must include, depending on who you go to, make sure the tax professional knows what they're doing, or if you're DIYing your taxes, make sure you know what you're doing, because it's very important that you check the box or indicate in the software this taxpayer is claimed by another dependent. Okay, that's important, because without that, then when the child files or whatever the case may be, you're not going to be able to claim them, because it's going to be presented as if they had claimed themselves. So some of you may be saying, well, why would my child want to file? Well, back to what I said, if federal and state local taxes came out and you're still claiming your child, then yeah, you should file, because they're due to get that back. Like I said, as long as you indicate they're claimed by another taxpayer, which is you, then they're going to get back those federal and state taxes that were taken out. So it's not the worst thing in the world. But if there were no federal, state, local taxes that came out and it was just Medicare and Social Security, no, then that doesn't apply to them. There's no filing necessary. Okay, so let me first say that. Now, and that was like a 2-in-1, because my next note here is like, should the child file or not? And now I'm going to go to another question I got this summer. Can the child still be claimed by me if the child worked? Okay, so here's the thing. If your child is under 19, absolutely. Okay, yes, you can still claim your child. All right, and I'm talking about for most taxpayers. I mean, nowadays, you can never tell. You actually have some children out here who are entrepreneurs. I'm sure a lot of you who follow me even seen some entrepreneurs whose story I shared, but that's not your typical, situation. But for the most part, what I'm saying is that, yes, you can still claim your child if they're under 19, And the other thing is, if your child is over 19 but under age 24, as long as they're still a full-time student, yes, you can claim them, and they're not, that same other situation applies in terms of how much they made for the year. So let me also say that. Yes, they would need to be a full-time student if they're between the ages of 19 and 24, but then it does also depend on their income limit. Now, I usually kind of tell people a safe guideline. When I say income limit, I'm kind of referring to if they made over like 10, 11,000, 12,000, okay? And some students maybe were working prior to the summer. So they might possibly have made that amount. And depending on your income, that's kind of like where it's decided, okay, can I still claim the adult child or not, whatever. So it definitely depends on those things. And that's why it's good to make sure, you know, you're working with a qualified tax professional who understands and can figure out the best route. Because what I've done for some of my clients, I'll say, okay, hey, let's assess and see what your child made, what you made, because it may be to your benefit to just still claim the child, even though they made a certain amount, and still let them file. And if they're going, they might still get a small refund, or they actually might owe a little something. But if you're not claiming them and you wind up owing a lot of something, that to me just doesn't make sense. So you got to kind of weigh the options, you know. And that's just like the different approach that I personally take when I'm working with my clients. All right, so now let me go over some more stuff. I'm still along the whole back to school edition. Okay, now let's see. All right, so when it comes to like college expenses, there are some credits. Now, if you have a student going to college, you know, parents be aware of some credits that you may be eligible for. And if your child is already in college, you probably already experienced getting some of these credits. Hopefully, your tax professional was doing it right, or if you're doing DIY, you were making sure you get those credits. But one credit is called American Opportunity Tax Credit, okay? It's a credit of up to like $2,500 that, you know, if qualified, you can get. The student must be enrolled minimum part-time, okay? And it can be for whether they're in for an associate's degree, a bachelor's degree, or another recognized credential. Okay, so that's the American Opportunity Credit. Then let me also say that when it comes to the American Opportunity Credit, it actually phases out. If you're a single taxpayer and your income is like over $80,000, unfortunately, you're not going to be able to get the credit. And if you're married filing jointly over $100,000, then yeah, you can claim the credit. Now, there's also something called Lifetime Learning Credit. Okay. Oh, I'm sorry, I'm jumping around. But back to the American Opportunity Credit, it can only be claimed in the first 4 years of school. Okay, so let me be clear on that. Now, the reason why I doubled back and said that, because the Lifetime Learning Educational Credit is not, you know, there's not the 4-year limit. Like, you can actually claim that after the 4 years. The one thing that's important to know is that they can't be combined. It's like you either have to go with one or the other. All right. Now, the Lifetime Learning Credit is usually, well, it's going to be about 20% of up to $10,000 in educational expenses. Okay. And mind you, these credits, yeah, I mean, I guess all of you know, but in case you don't know, yeah, these are for educational expenses, tuition, you know, supplies, room and board, whatever, and supplies even down to a laptop. Yeah, you can get credit for that up to these maximum things if you qualify. Now, with the Lifetime Learning Credit, there are income phase-outs. If you're single and you make over $57,000, unfortunately, you won't qualify for the Lifetime Learning Credit. If you're married filing joint, the income limit is $114,000, so you wouldn't qualify in that case. Okay, put this because that's something I want to come back to. So yeah, now you do have, wait, pardon me, trying to hurry not to keep y'all too long. There is another credit, okay, called, well, it's not really a credit, but this one is a deduction actually, and it's called tuition and fees deduction. And certain, like all the other credits, etc., there are certain criteria that apply. you can't make over certain incomes. I'm looking to see. I didn't write the income limits down, but your income can be higher. Let me say that. Okay, that's the good thing about the tuition and fees deduction. Your income can be higher than those for the American Opportunity and Lifetime Learning when it comes to tuition and fees deduction, which you can actually claim up to $4,000 deduction from your income. All right, and if you meet the certain qualifications. Okay, now let me skip around. All right. The next thing I want to mention when it comes to this whole back to school thing is that, all right, now you have some people who have expenses for educational work-related stuff. And before, you used to be able to claim those work-related expenses. Well, yeah, work-related educational expenses, but wow, they eliminated it. So unfortunately, the new people in office who made these tax changes, you know, we're not going to be able to deduct educational costs for work-related anymore. All right, but here's a loophole. If you're self-employed as a sole proprietorship, partnership, or LLC, then you can actually kind of, you know, finagle that, I guess you could say, as long as it's in your industry or whatever. And then in that case, you can claim the expenses. You know, I stay telling people, I know I talk a lot about entrepreneurship, but it definitely ties into a lot of tax benefits and tax breaks that you get, even with a side hustle, okay, even freelancing. So that's what you can do with that. So, you know, you may kind of want to juggle depending on what your industry is. Let me just throw something out there. If you're like, let's say a graphic designer at work or whatever, okay, and normally now if you're doing something to further your education, take some classes for work, you can't deduct them. But if you have a side hustle as a sole proprietorship doing graphic design, you can write off those expenses. So that's what I'm trying to tell you, okay? More along the lines of back to school stuff. All right, now let me say for educators. Now, if you're an educator, hopefully your tax person that you go to, if you've been doing your own taxes, hopefully you've been claiming the $250 deduction for out-of-pocket classroom supplies. All right, and at first they were actually trying to do away with that, but thank the Lord, a lot of educators and school systems, you know, spoke up and advocated for themselves. So thank the Lord they kept it. So yeah, you can still, teachers, you can still write those off, but it is capped out at $250. But again, if you're an educator, but as a side hustle, you do tutoring and whatever, education consulting, believe it or not, yes, that's a growing field. And now you're buying supplies for that. Now they are deductible. Okay? So it's, you know, pay attention to those things. All right, let's see what else. Okay, we have student loan interest. All right, as you see, all of these tie into back to school stuff, whatever. Okay, so student loan interest. Now you can claim a maximum of $2,500 of student loan interest that you paid for the year, paid out for the year. There is unfortunately a phase out of income. So if you're single and you make over $65,000, then you can't claim this student loan interest deduction. And if you're married filing joint and you make over $135,000, yeah, unfortunately you can't claim the student loan interest deduction. It's just interest that you paid that unfortunately you can't claim. And if you're married filing separate, you, regardless of the income level, you're not even eligible for it. And by the way, that's just like, I stay telling everybody, that's just like one of the worst filing statuses to claim, married filing separate. It just removes so many benefits. It's ridiculous. But I get it. Some people prefer to do that because your spouse may have some serious tax situations going on or child support situations going on, and you don't want to be tied into that. So you got to kind of weigh your options and see, you know, hey, what's the greater goal here? What's the bigger picture? And then make a decision from that. The other thing, have you heard about the 529 savings? Okay, it's like an investment. And it was a program that was started many years ago by a lot of the state tax agencies. And it was to benefit putting away money for your child's college education. All right, but one good thing I must say that this, new tax law change did for this is that, guess what? Now with the 529 savings, it can actually apply to all grades, not just college. So it is going to be good for kindergarten through 12th grade. So that's great, because if you're planning on putting your child in private school, or you already have your child in private school or whatever, and you're going, using your 529 savings to invest or whatever, it's going to benefit you with the taxes. Okay, so let's see. Oh yeah, I put a note here because some people do homeschooling, but unfortunately it covers all education except homeschooling. Okay, the other thing, and then I'm pretty much going to be wrapping up. This is not really a back to school part, and I'm going to try and do some other videos on other topics, because I'm starting to realize a lot of my questions that I get from tax clients, it could benefit a lot of you out there who are not my client, and I know there's so much information out here, but sometimes it can be a little confusing trying to connect the dots. So, that's why I try to sometimes use my platform to educate the masses, get the information out there. You'd be surprised at some videos I come across that just have such wrong information, and I just be sitting there like, did they really just say that? Okay, so lastly, just really quick, it's looking like they've made changes in a sense that, okay, you know how we used to have like different filing statuses, head of household, single, married, filing joint, married, filing separate. Well, they've eliminated the head of household filing status. Okay, you're either going to be single or married filing joint. I think there's still a married filing separate, but in any case, yeah, those are the primary two filing statuses at this point. And again, I've been doing my research and everything, because y'all know I got to do that to stay on top of these tax laws. It's really not the worst thing. Head of household used to be a great filing status because it really maximized your standard deduction, and I might need to one day do a video on standard deduction versus itemizing, because it's important to understand and find out which one is to your greater benefit. But yeah, so head of household status used to be great, but now they've eliminated it. But the thing that they did do is they did increase the standard deduction, which is really good, because you had some people who were single, and because they don't have a dependent, they couldn't claim head of household, so they therefore missed out on deducting a good amount of money from their income. Okay, but now that they've raised the standard deduction for single people, etc., and for married filing joint, it can probably benefit you in a better way. So that'll be a good thing. And the other thing I wanted to mention, they've changed the tax brackets, and it's good to kind of know which bracket you fall in. I'm just going to throw them all out there, and then look at my notes where I put most people fall into, these two categories. So the tax brackets, the new tax brackets are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. And I will tell you, most people, especially most people who are my clients, they fall in these two categories. 22% if their income falls between $38,700 to $82,500, and then the 24% tax bracket are for people who make a minimum of $82,500 but up to $157,500. Okay, so that's the 24% tax bracket. And it's just important to get to know those to kind of understand or get an idea what your annual tax liability will be. Okay, so you're welcome to send me your questions. If you're not familiar with my website, it's 𝐅𝐑𝐄𝐒.com. That's spelled HARDGE, the word connections with an S at the end.com. You're more than welcome to subscribe to stay in the know of things, get updates. All right, and then I want to just let you all know to be on the lookout for some upcoming courses that I'm going to be putting together on different topics. For right now, I'm really going to be sticking to like entrepreneurship topics mindset topics, and definitely some tax topics, things you know it's good to know. So these courses I'm going to be putting together, and I'll announce them when they're ready and give you links to sign up, etc., etc. Okay, so I thank you all for watching. I hope you found this information valuable. Please share if so, and until the next video, take